Welcome to the Tinnelly Talks podcast, where we dive into the common legal issues facing today's community associations. Whether you're a manager, board member, or homeowner, you're sure to pick up on some nuggets of advice to help you build a successful community in this ever-evolving and changing world.
Hello and welcome to Tinnelly Talks. I'm Ramona Acosta.
And I'm Steve Tinnelly.
And today we'll be discussing the current state of fire insurance with Patrick Prendiville. Patrick started Prendiville Insurance Agency in 1988 after graduating from the University of California, Santa Barbara. Patrick's earned the Community Insurance and Risk Management Specialist, or CIRMS, designation from the Community Associations Institute. Over the years, Patrick has been actively involved in multiple chapters of CAI, serving as president in Orange County and San Diego counties, multiple committees, multiple awards. Thank you for joining us.
Thank you so much for having me. It's a pleasure to be here.
So we wanted to invite you in today to help us understand what the heck is going on with HOA insurance, because we're hearing crazy stories about policies going up 100, 200, 300%.
Yes, or more.
Or more.
Yeah.
So why is the insurance, why are rates going up so high?
Well, first of all, let me tell you, it's the worst insurance market I've ever been through, and I've been in business for 33 years. I survived the Northridge earthquakes, so it's just a really bad market. So 3 things fundamentally are going on. Number 1, the reconstruction cost to just rebuild is really dramatically rising. We have a situation where in the past years you have a 3% roll for a building valuation. You know, if we thought it was going to be $1 million, we had 3%. We're seeing major jumps on that. And so all of the costs are going up. And it's not just simply because of supply chain issues. This has been a trend that's been going into that. And so construction cost, number 1, is a big problem. Number 2, we have major reinsurance issues, which relates to number 3, but let me define that because it's really an insurance term that consumers don't talk about, but it really should be. Basically this, reinsurance is when insurance companies such as State Farm, Farmers, Allstate, AAA, whoever it is, they turn around and they'll be, let's say they insure $100 million of risk in the city of Mission Viejo. They don't want to pay out $100 million, so they turn around and they buy insurance from other insurance companies. Could be one, could be more. It's called the reinsurance market. It's a huge market, but it's like a real insider industry term. Well, the problem is the reinsurance market, because of claims activity, has just really gone upside down. So insurance companies that are reinsuring have lost so much money that it's reduced the capacity, which is their ability to go out. Like instead of having 100 million of exposure, they don't have 100 million anymore. So the prices go up, and it gets all the way this ripple effect. It's hurt the whole industry. And the reason all that has happened is because of the third reason why rates are going up. It's just good old-fashioned claim activity highlighted by wildfires, certainly. But it's not just wildfires. It's just claims are up, from liability claims, property claims, but big catastrophic claims from wildfire. There's a long tail. If you think about Santa Rosa, that was a few years ago now, right? 2018 maybe? We're just really seeing it hit full swing now for those claims that happened.
So this is not really fire insurance, but just property insurance in general. We have another episode where we talk about water damage claims, and we talk about the importance of filing claims when there's a loss.
Correct.
But now we have associations that are running into non-renewals. So, you know, I think associations are kind of in a conundrum as to what do we do? Because we teach them it's not about protecting the policy, it's about filing the claims and maintaining your assets. But now we're running into, well, now our premiums are going up, you know, hundreds of thousands of dollars. And, you know, even if we can get, you know, we're probably going to end up in the surplus or the secondary market because we got a non-renewal from the preferred carriers, Farmers, State Farm, Allstate, et cetera. And we can talk more about what is a preferred market and what is a surplus market, but
sure.
You know, what do we tell our boards and what do we tell our managers when we're talking about we got to protect the policy?
Well, it's a great question. When you're talking about high-frequency claims such as water damage claims, we still have controls for that. And I think it's time the boards take it more seriously as far as what they need to do. Get a water intrusion policy, increase your water damage deductible, preach maintenance to your owners so you can really control those. A lot of water damage claims certainly are very expensive, but many of them are $10,000, $15,000, $20,000 just repeated. So get the deductibles up. On a fire claim, especially a wildfire claim, it's much more difficult obviously because pretty much any fire is going to be over whatever the deductible is. pretty much.
So associations that are getting non-renewals,
Mm-hmm.
are those non-renewals coming because that particular association had a lot of fire claims, or is it because of where they are located that they are backed up to, open space and there's higher risk because of where the association is located, that there might be a wildfire risk associated with it?
I would say both of those reasons, their own claims activity or where they are located, but you have some where it's both. And those are the ones that are in real trouble. Because you've got a bad brush area, oh, by the way, they're not profitable already.
Mm-hmm.
So that's a really particularly difficult thing, which is why it's important to control claims, especially if you're in a borderline area.
Right, because I know that California legislation was updated, I don't know if it was last year or 2 years ago, I think it was last year, where our fuel modification zones, for those associations that back up open space, they have fuel modification zones that they have to maintain on an annual basis. And it basically creates a border around the community from wildfire. And I know that legislation was updated last year to expand those fuel mod zones so there would be more of a perimeter, more of a boundary. But it sounds like that's not really impacting the insurance side of things.
You would think it would, Ramona, right? It's like, hey, we have 150 feet, now we have 250 feet. But unfortunately, where the property underwriters are right now mentally, based on the numbers, is that they're so concerned about wildfire risk that very little is going to appease a bad placement on a fire map. And maybe I can just talk about the fire maps for a moment?
Yes, please.
Okay. So every insurance company pretty much has their own unique map. Some have some common ones, but some common ones are Risk Meter, which is put out by CoreLogic. Another one is Willis Re. Another one is Munich Re. There's also the Cal Fire map. And so these companies subscribe to one of these, or they have their own proprietary map where they just paid somebody to come in and create their own map and nobody else gets to see it. So the problem with these maps is that they're really not 100% accurate. I mean, I don't care what company it is, I don't care what fire map you're using. You will find an association that makes no sense. It's like, how could this association possibly be deemed to be in a wildfire area? And by the way, it happens in reverse too. It's like, how is this association not in a high wildfire area? It makes no sense to me. And so it's important to know that the insurance companies all have different fire maps. So when we talk later on, if we talk about how you shop it out, which I think we should talk about, that's a really important factor as far as which fire map are you on, and have all the companies representing these fire maps looked at the risk. So that is something that's really important to know.
Okay, so what I'm hearing then is that there's not really anything that the association can do from a prevention standpoint, right? Again, going back to water damage claims, there are things that we can do, right? Like we can repipe, where there's preventative maintenance that we can do to the association that can help us lower the possibility of having claims that will eventually help us reduce premiums and
Yes.
so forth. But in this particular case, it doesn't really sound like that there's much that an association can do to say, what can we do from a maintenance standpoint or from a business standpoint that's going to help us prevent this from happening?
As I hate to say it, but this is really the truth.
This is
on a water damage claim, like, hey, they've had a lot of water damage claims. However, underwriter, they repiped, they did this, they increased the deductible. The underwriter starts going, okay, maybe we can't take a risk with this account. When it comes to wildfire, as of this moment, now I'm hoping this isn't always the case, I don't care if they say they have a volunteer fire crew on standby or a paid fire crew right outside the gates community. If they are placed in a bad fire map position, I don't care what happens. As depressing as it is to say it, it's going to be a tough risk.
So this is the reality.
That's how paranoid they are.
Yeah.
So what needs to change with that though? Like how does it need to change in order for underwriter standards to be able to factor into things that, hey, this association just spent $500,000 on fuel mod and it's basically barren dirt, in a 200-foot wide perimeter around the entire community, even though they've never had anything. He says it doesn't matter. They're here on this map, and unless they can pick up the community on a truck and drive it over someplace that's not in a fire map, that's the only thing I'm going to look at. Like how do those standards change?
Well, okay, so the great question. Before I answer that, though, I want to just point out one other thing, okay, which is this. We're talking property exposure, okay? Insurance policy is like a coin, I would say. You have heads and tails. You have liability and property, right? So really, I'm not trying to send the message, don't worry about fuel mod, don't worry about trying to do fire safety. I'm not trying to say that at all, because if you do, then you flip the coin over to liability and you have a huge liability claim against the board for not fortifying the association. So I want to make that really clear.
Absolutely.
But what you end up doing, basically, you should do all those things. And what has to happen for it to change? Number one, the Department of Insurance is getting aware of all of this now. And so there's a lot of activity going on where the Department of Insurance is looking at it very, very closely. I don't know for sure what this is. I wish I could sit here and tell you exactly what it is. I think we need some luck on our side, certainly. Some lower wildfire exposure, definitely would help out a lot. We need new markets to come in. I think it's going to be a time, it's going to take some time on the calendar for the insurance industry to kind of recollect some of their money that they've spent, have the reinsurance markets thaw. This could just be a timing thing. We have to kind of wait it out. Because right now, there's really nothing on the agenda that's going to fix this problem overnight. It's just going to take some time to thaw out.
So if it took a few years for the wildfires to actually start seeing it being reflected in the cost of insurance, it's realistic to say it's at least going to be another few years before we get on the other side of this thing?
I personally believe that.
Okay.
There's really good agents that probably would disagree with me on that. Some may say it will take longer, some may be more optimistic. I think it's going to be a few years of a really bumpy road. And I think when it changes, it's going to change quickly. It's going to be coming out to, all of a sudden you have a situation where you have an association that's been in the E&S market, excess and surplus lines marketplace, paying obscene premium, and all it's going to be like, hey, guess what? Carrier X, who's in the preferred marketplace, is willing to insure your association, and their rates are just going to drop overnight.
So let's talk about
That's
that.
what I think is going to happen.
Let's talk about the preferred market versus excess surplus lines or the secondary market, because I think most people, I think that sounds like Greek to most people.
Yes,
it's like,
it does.
right? I mean,
Yeah.
it's insurance is insurance is insurance. So
Right.
if we could talk about preferred, admitted, non-admitted, secondary market, how that impacts our HOAs.
Yep. Okay, so imagine a road with a fork, big fork in it, right? On one hand of the fork is the preferred or standard marketplace. And that is the companies that everybody knows of. Companies that advertise on TV, Farmers, State Farm, Traveler, and it goes on and on and on. There's many, many companies whether they advertise or not. There's many of them. It's preferred. They're for the most part, heavily regulated by the Department of Insurance. Where if they want to make a rate change, they go to the Department of Insurance, they say, hey, Department, we want to cut our rates or we want to increase our rates. Can we do that? It's a big, negotiation back and forth. They're very, very strict. That's who most associations are through, okay? But the other fork in the road is where you go into the high surplus lines. So think about Lloyd's of London. That's like generically we say it. It's like way back in the day, we'd say, could you Xerox this for me? And it wasn't Xerox, it's that Xerox dominated the copiers, right? Lloyd's of London is that. And so basically it's a huge marketplace, goes back hundreds of years, and basically it's a high place. So it's earthquake insurance is always in there. Anything to, insuring satellites, ports, anything that's high risk. Well, wildfire is now high risk. So if the standard marketplace declines a risk for it, then it goes to excess or surplus lines. There's not as much regulatory action from the Department of Insurance. The Lloyd's of London type of market can charge whatever they want to charge, whatever they think they can get.
So that's how we're going from a $25,000 premium to a $300,000 premium.
Exactly. And it goes further than that. Let's say you had a carrier, and I'm just going to pick a name. Let's say it's Travelers, right? Travelers like, look, this community is in a high risk. We're willing to do it, but all we can do is charge X because that's what we're filed for. That we're at the top end of what we can charge. If we could push it out and go further, maybe we would do it. So maybe there'd be a middle road, but the Department of Insurance doesn't want to allow them to do that because they're trying to be who they are, which is a consumer protection agency, which they should be, and they're trying to keep the rates in check. So you have this big gap in the middle where it's a big empty
It's
zone.
kind of counterintuitive. You protect the consumer by not allowing these primary or preferred, right, insurance agencies to do it, and then forcing the consumer into this excess surplus where they're going to get raked.
There's a big gap in the middle. You're right.
Well, and in addition to the skyrocketing premium rates, there's also the issue of the amount of coverage.
Correct.
Because typically when you're in the secondary market or the excess surplus lines, you're not being insured to value. So you're not getting where your CCNRs require quote unquote full replacement cost. My understanding is that in that secondary market, you're probably not going to get that. So even though you're paying 3 times as much or 4 times as much in your premiums, you're probably getting less insurance coverage.
Correct. This has really been going on for about 2 years now, and so we've been in the thick of it. We have associations that would have a $40 million total insured value, meaning in order to rebuild, it would be a $40 million, and maybe 60, maybe 70, 80, whatever it is. I have all these outrageous in my book. And last year we were able to get, or the previous year we got them the full limits, and we got them maybe a $50,000 premium. That policy has now grown to potentially $300,000, $500,000, $600,000, $700,000. And instead of getting the $40 or $50 million in total insured value, we can only offer them $15 million. So if they have a claim over that $15 million mark, they're out of coverage. And it goes back to that capacity issue I mentioned earlier. From the reinsurance underwriters, they only have so much to go around.
So for both of you then, what is an association, what's the board of directors supposed to do? Because if they're required to have $40 million of insurance and they can only get $15 million, what is the risk to the association and to the board of directors because they were unable to insure, they were unable to get that full replacement cost? They're essentially in breach of their governing documents. So what are they supposed to do?
Well, I always refer to the attorney, so I will today as well, but I will also say from the insurance agent's perspective, I just think it's a matter of the board can only do what they can do.
Right.
If the market doesn't bear the opportunity to buy it, I don't see how they can be scrutinized, but certainly.
Yeah, well, I mean, it's okay. So if somebody has an issue with the board, you breached fiduciary duty, right? It's essentially a liability claim, right? You failed to uphold a duty of care. But in performing that duty, okay, how did I operate? I mean, I would happily be able to fulfill my duty and be able to purchase a product. I want to purchase the product. The problem is that product doesn't exist. And the most I can do is buy a third of the product at 10 times the price. And that's really all that our community can do. So I don't have much of a concern from a liability standpoint from a board that actually looked at this and said, okay, what is the best option here? What is the most coverage that we can get in a way that we can pass it legally and pass those costs on, rather than someone saying it's just too expensive this year, we're just not going to buy it. Fingers crossed. Hey, nobody go, smoke in the common area because we're uninsured at the moment, right?
So for the homeowner that's in the building that burned down, or the association that burned down in the wildfire, and it was $40 million that they were supposed to have, they only got $15 million, and so now we can't rebuild, right? So the homeowner's going to sue the association, and I agree with both of you. I think that the boards can only do what boards can do, and they're limited by what's available to them. But Steve, you always talk about paper the file. So how do we document this so that there's some protections, so that the board can set themselves up for some protections down the road?
Yeah, I think, it would be, and this is one of the reasons why it's glad that you're here. We always, hammer on our clients to really develop a working relationship with their insurance agent and their insurance broker to help them understand what the situation is and be able to explain it to the membership, put them on notice. I don't know this, but is there some type of surplus product that an individual owner could purchase? Just say, hey, listen, we're underinsured. We can't get the full insurance that we need, but you as an individual homeowner are going to need to go out, and there might be this excess product that you can purchase, and you put your entire membership on notice, right? You pass the duty on to them. Is there anything like that that's available?
It's not really an excess product. However, it's your normal homeowner's unit owner policy. The HO6, that is what they want to really beef up. So number one, they want to get plenty of interior building coverage in case they run out of money from the association side. If you have a walls-in policy, meaning the association takes care of the cabinetry and the flooring, buy that on your own policy. It's not too expensive. It's good to have it in case you need it. But number two, and this should really be loudly told to the association, every unit owner should be encouraged to buy individual loss assessment. Now, the normal maximum amount you can have is $50,000. But what if you have a situation where your policy runs out of limits? And then you need more money. Every unit owner can go to their own individual policy. It's a fire claim. It's always covered. And you get up to $50,000. Take $50,000 by the number of units. It will add up pretty nicely. And it's cheap. That's the other item. This is a $20 per year premium for the unit owner, give or take.
Yeah. So, I mean, it's just having that type of conversation and doing it in the purview of your membership. Just laying it out for your membership. I think a lot of boards, they get frustrated by this, or sometimes they're a little apprehensive just to be candid with their members. Hey, guys, the insurance market's crazy right now. This is what the situation is. We're going to have to levy assessment to pay for insurance that we're supposed to have. And to make matters worse, we cannot even purchase a product feasibly that covers what our CCNRs say that we're supposed to cover, which we've had in place for years. So we've done some investigation for you. We've talked to the professionals. These are things that are available for you, knowing that the association right now can't cover everything that you're expecting it to cover. So you as an owner are going to have to, step in and do that. And
as they always should have done anyways.
Yeah.
Now it's really important.
Yeah, it's really important, right? And then as a, if I was the liability carrier for the board, I'd say, thank God that you're doing that.
Yes.
Right.
You got that right.
The nightmare scenario is a board that just tries to sweep this under the rug because they don't want to upset their neighbors, right? Rather than just disclosing and giving everybody the information and the opportunity they have to, okay, you guys have to mitigate some of this risk independently. We can't do it as an HOA, right?
Exactly. That's exactly right.
So it sounds like there's not much available. It's hard to say that this kind of is what it is at this point.
Totally. And that's
the unfortunate side of it, but I feel like that's kind of the message that we need to send
It is what it is.
Well, I don't want to pin it quite that way.
No, but
there are a couple things.
Yeah, and that's what I want to talk to you about.
Yeah.
Because as a manager, have always been taught you don't need to shop out insurance. You don't need to shop it out every year, right? If you've got a good policy and you've got a good relationship with your agent and you've got adequate coverage, a good premium, you don't need to shop it out every year. Given the current circumstances, should we start shopping it out? And what about the underwriters? Because that's the other issue is underwriters don't like to see it shopped out all the time as well. They don't like to see multiple agents coming to the same underwriter. It's kind of a red flag. So what do we do?
So it's two-pronged. Number one, on the preferred side, you need to shop it out. So you need to make sure that the preferred companies have all seen your risk. Because you could have one company that uses maybe Munich Re fire map, and that maybe they're the only one using it, and for whatever reason, they're not concerned about that location and they're willing to do it. Problem is solved. You just switch from Travelers to whatever the company is. So that's important because it's important to note that not every agent or every broker has access to the entire marketplace. In fact, there's no one broker or no one agent that has access to the entire preferred marketplace. They have to go through wholesalers and it's a lot of work. So you have to make sure that the preferred marketplace has seen everything.
So you're not just shopping insurance, you're actually shopping fire maps.
That's exactly right. You're shopping fire maps.
Could there be two carriers hypothetically that use the same fire map?
There for sure is.
But that will price that risk differently, even though you're on the same location on the map, but they just look at it as,
Assuming that they're not in an extreme higher fire, because this isn't a yes or no.
Okay.
This is a measure of degrees.
Okay.
So if you have a situation where it's a moderate fire risk, they're going to pay more than a low fire risk, but the insurance company is still going to want to give them insurance. It's going to be a higher premium, right? And then it gets closer and closer to the edge. Then it gets to a point where there's a line of no return. It's extreme fire risk, and the preferred marketplace is simply saying no. It's just that you might have another preferred carrier who has a different map who doesn't define that as an extreme wildfire. Maybe they look at it as moderate. So it does happen.
Have you ever seen two preferred carriers with the same map? One says that's moderate, one says that's high fire?
No, because they're following the same map.
Then the map is the map.
The map is the map.
Got it.
Today's episode is brought to you by Altera Assessment Recovery. Altera provides comprehensive attorney-supervised assessment collection services to community associations throughout California. Trust us with your collection needs. We'll get the job done right, and as quickly and efficiently as possible. Altera Assessment Recovery. We're the collection team you've been looking for.
So you mentioned shopping out carriers, but also shopping out agents. And we have independent brokers, and then we have farmers agents, and State Farm agents, and Allstate agents, and so on and so forth. And one thing that you've always taught me is that you're a farmer's agent, but if farmers declines it, then that opens you up to then shop it out to the market.
Correct.
So I'm a manager and I have an association and I need to shop this out. Do I just send it to you, or should I be sending it to 3 different agents that I work with that I know? I mean, what is your feel for that?
3 might be overkill for the preferred. So what I would do is I would talk to the agent that has it and just have the agent specify which companies they're going to check with. Mm-hmm. And then you go to another agent and say, these companies are going to see this risk. Do you have any other preferred companies besides what we have here on the list?
So we have to dive a little bit deeper in our RFP process.
A little bit.
Okay.
And now it could be your agent is going to convince you that they have access to the entire marketplace, and maybe they do, but you want to make sure that that is the case, because that could be a really big mistake. It could be a really big mistake. So that's the preferred side of it. Now, on the excess and surplus lines, that is a different story altogether. You should go in with one broker that you trust, because the underwriters do not want to see this risk from 5 different agents. And intuitively, as consumers, we think, well, we better shop this out. More agents is better than one. Here's the problem. Let's say there are 12 excess and surplus lines carriers available to this association. If you have 3 brokers go out and block those 12 in some combination, maybe they each have 4, or it's a split, however it's split. The problem is that we as agents, we need those companies to layer the policies, because that's what we've been doing. Like right now today, I'm working on one where we have a $15 million sublimit of insurance for fire. We have 3 different insurance companies come to the table for that. Well, if we have other brokers who maybe another broker has my second leg, then I can't deliver the $15 million. So it's important to note that as long as you have a broker that you trust, and you trust that they're doing a thorough job, if you have a trust issue with your agent, get a new agent anyways, right? But just on the excess and surplus lines, it is not wise to have a bunch of brokers stocking the market. The underwriters don't take the application seriously. The brokers step on each other, and it doesn't really serve anybody.
So again, I'm trying to whittle this down, because I know we have board members as audience, and we also have managers, and so as a manager, right? I don't know.
Right.
I don't know what I'm shopping at. I'm going to my agent. I'm going to you, and I'm saying, Patrick, here's my CC&Rs. I got this non-renewal letter. I need insurance. Do what you can for me. I'm not going to know if I'm in a preferred or surplus until you come back to me and tell me what you were able to give me. So I'm thinking that I need to go to one agent first, and based on those results, then I need to start shopping.
Precisely.
Right? Okay.
And I would say the incumbent agent makes the most sense.
Yep.
If you have a good relationship with the incumbent agent, have the communication with him or her, who are you going to in the preferred marketplace? Who are you going to in the excess and surplus?
So ask that up right at the front, or wait until the numbers start coming back?
No, right up front.
Right up front.
Right up front. Don't
Got
wait
it.
for the numbers, because the numbers may be hindered by what's going on in the background. You could prevent it. Also know that if you're going to maybe a State Farm agent, well, State Farm is very clear. Their agents can only do State Farm, so they won't get you the excess and surplus lines. So it kind of just depends on who it is.
Right.
Got it.
And not to pick on State Farm, because quite frankly, State Farm, during these wildfires, they've been doing a good job in the industry.
So I'm a manager. Hey, Patrick, I need insurance. Please let me know who you're going to get numbers from.
Exactly.
Got it.
Preferred and E&S.
Yeah.
Got it. And then once that information comes back, then is it up to me? Do I have a conversation with you saying, okay, well, these are the preferred carriers and the E&S carriers that I know Patrick's going to look at. How do I know what other carriers there are to ask somebody else if they could look at those carriers?
Most managers have 1, 2, or 3 agents they trust.
Okay.
Call the second agent and say, this is what's going on. This is where the account's going. Do you have any other markets, the preferred marketplace, that will fill this in so we get a full look and the ideas? And if not, then then you just let the first broker go with it.
Have you ever seen a situation where there's 2 agents or 2 brokers that are, tap the same carrier but are able to get 2 different premiums?
Well, that happens from time to time.
Okay, but that's rare. Don't expect that to happen.
It's rare, but it happens.
And it usually requires a broker of record letter and a whole bunch of other
Yeah.
stuff.
It does happen sometimes.
It's not like, hey, your premium's $100,000. Yeah, but you don't understand. We're working with Patrick Prendiville. Oh, okay. In that case, you guys are in good hands. It's only $60,000. Okay, just wanted to get that off the
like
table.
a good neighbor, you're in good hands. I don't think that's any trademark violation, is it?
Good neighbor, good hands. I love it. Okay.
And how soon should we start? Because again, back in the old days, right? I mean, you didn't shop for insurance too early. There was a time when it was too soon to start. Non-renewals come about 60 days out? 60 days, 90 days?
You should get it within 60 days of the renewal. You're probably going to get it in like 65, 68 days typically.
Okay.
But 60 days is supposed to be what legally. I think it's 45. I don't even know. They're very careful about that in Ramona, so it's usually not a problem. They usually get that non-renewal notice. In fact, what they do is this. If they come too close and they're in that window, they extend the cancellation date. So it used to be March 1st, now it's March 10th.
Right.
They needed those extra 10 days to make sure you had legal notice.
Right.
And they really built up some conservative time estimates there.
Because again, going back to nuts and bolts, where you have manager gets a non-renewal notice and it goes on to the monthly board of directors, it goes into that board packet and they notify the board and then they go out to bid. And so you don't want anybody to be surprised and you don't want anybody to feel like they're under the gun. But start early, start late? I mean, is it going to have any effect on premiums? Because this market is crazy right now.
It's start early. You want to start early, especially if you're going to be one of those unfortunate associations that's going from 50 to 500 or more. It's about communicating to the association what's happening. So starting early is smart. And if you're in a wildfire area, you pretty much know it.
If you're in a wildfire area...
So you could just call the agent and go, what do I look like? You're not going to hurt yourself by having that conversation.
Well, that's what I'm asking, because most CC&Rs, they require an annual review of the insurance policies. And this is something that Steve and I have talked about on a couple of different other episodes, is have your insurance agent come in and meet with the board of directors and talk about insurance policies. So if you're in a wildfire area, or if you have a bunch of claims and your insurance is coming up, your due date is coming up, call the agent, have them come into a board meeting. Let's get the lay of the land.
Absolutely.
Before we can go out to bid.
Absolutely agree with you, 100%.
So now you've been talking about these increased premiums, $700,000 premium. I think, what'd you say? You had one that was $65,000, then went to $700,000?
I have several like that, yeah.
So that's not in the budget.
Right.
So how do we, Steve, how do we pay for that? Because we have civil code limits, right? Like, we can only raise assessments 20% per year. We can do a special assessment of up to 5% per year. We can go out to the membership for a vote. That takes time, which we may not have that time given that 60-day window, right? Because that requires the double secret ballots. So what do we do? How do we pay for it?
Well, I mean, I'm just kind of, putting this in my head right now. I'm just imagining, 40 unit or 100 unit development getting hit with a 3x or a 4x premium increase, right? And you don't have 1,000 homeowners to spread that around. So you're looking at a pretty sizable assessment increase. I mean, Davis-Sterling Act, we can levy an emergency special assessment. We could do that. I could think it'd be an emergency basis, but the problem is that I believe the language of the code says for unforeseen and extraordinary expenses that couldn't have been reasonably foreseen by the board in preparing the budget. So if you're in a situation where you've got these increases and you're sitting on it and it's going to be very expensive, but you still go through your budgeting process and you prepare a budget, and then after the budget's released, a few months later you want to levy this emergency special assessment, I think that's grounds for plaintiffs' attorneys to get in there and start crying foul, because the board knew that this expense was coming. So I think it is something that you just have to address head on. And if this is the expense that you're looking at, talk with legal counsel and say, well, yes, we probably have to raise assessments this year, and right after our fiscal year ends, we'll probably have to raise assessments again, and then we're going to have to do that probably in conjunction with an emergency special assessment, just to make sure we can float the premium. But
yeah, I think what I struggle with is that you may know that you're in a wildfire area. You may have an indication that you're going to be hit with an excessively high premium, but you have no way to anticipate what that premium is going to be. You don't know if it's going to be $300,000 or $700,000, and so how do you adequately budget for that? Because it's budget season. I can call Patrick and I can say, okay, I understand that this is what's going on in the insurance market. What can you tell me?
Well, that's a difficult question to answer, because on one hand, as the agent, we don't want to give you a surprise and mislead you. On the other hand, we don't want to cause undue panic, because there may be a solution to this, right? We could find a different carrier that's willing to do it. So it is a little bit of a predicament, for sure.
Yeah.
Yeah. But
call your attorney.
And there are some other things that people are doing. So I don't know if we can kind of go into that now.
Let's talk about it.
So the premise is this. All of the HOA policies, they're in the commercial lines marketplace, right? They're not the personal lines. Personal lines is auto and home, life insurance. Commercial is shopping centers, office buildings, HOAs. It's a much different market, okay? So the commercial lines is much more, it's brutal, just for lack of a better word, than personal lines. So what if you could take your homes, and instead of having them as condos, which a lot of them are, if they fit the personal lines underwriting guidelines, such as they're side by side, right? They're not stacked condo units, for instance. Then what you have is maybe a possibility, if the CCRs are friendly enough to it, to maybe convert the insurance responsibility from the association to the individual unit owner. That will then put them from an HO6 condominium unit owner's policy to an HO3 homeowner's policy, and their premium likely, and everyone I've seen so far has worked, likely will go way down. Like it won't be a big deal in their life at all as compared to. Then what the association does is they insure the clubhouse, the pool, the streets, the mailboxes on a commercial policy. More expensive than it would normally be because they're still in a fire zone. But we're getting out of this whole crazy $500,000, $600,000, $700,000 premium. And now it's common area only. The need for insurance goes way down because you go down to whatever the values are. It's a much more friendly way of going if it works. And so we always say, talk to your attorney and see if this can be worked. If it can't be worked, then maybe the board should consider putting a vote to the association to actually change the CC&Rs, change the insurance requirements. It's messy. You wouldn't do it unless this extreme situation was happening, right? Like you would just, in a normal way, you would never say, I got a great idea. It's not a great idea necessarily. It's just compared to the alternative of spending $600,000 or $700,000, maybe it's something to look into. And several associations I've seen have done it, and they've been successful doing it.
So they've done it how? They've changed just the allocation of maintenance responsibilities between the association? Like, I'm just trying to
The
understand.
allocation of the insurance responsibilities.
We got lucky on one where the CC&R said that if the association is unable to acquire or afford insurance premiums for the condominium units, then the insurance obligation would be released to the owners.
Okay.
So then the owners went out and bought HO3 policies where it properly fit into that insurance as a attached homeowners policy.
And that's how you got the lender buy-in on that, because it was in the CC&Rs.
Right. Now other ones, they don't have those friendly CC&Rs, and that's kind of a one-off, right?
Right.
But is it the only one out there? I don't know that. But the other ones where they're stuck, it's like we don't have this convenient language in our CC&Rs. Then you put it to the vote of the community and you change the CC&Rs, whether it's for temporary or forever, and you just say, we are going to release the insurance responsibility to the owner. You satisfy the banks because A, they just want to make sure the coverage is in place. B, when we're talking about these policies that are $500,000, $600,000, $700,000, we're not talking about full limits. So the bank is never satisfied. They look at the community and go, wait a minute, you need 80 million of coverage. You only have 15. Well, that's where we are today. So the banks are never happy with plan A, right? Do they accept it? Yeah, they do. But they're not happy about it.
Got it. Yeah,
So
I've
they're
seen that.
happier going to the homeowner side if it qualifies for the personalized marketplace. I'm telling you, it's messy, but I just think that this is unsustainable. And as I said earlier, this could take some years of ironing out. If this was a one-time hit, that'd be one thing. But what happens if it's $500,000 this year and $600,000 the next year and then $650,000 the next year?
Yeah.
It could be devastating. So
and
I think it's
CCN.
time to at least have the conversation, think outside the box. A, are we eligible for personal lines? That's the first question to answer. And then B, is it something we want to go through? Is it really something? It's just a conversation to have.
Yeah, I mean, I've seen that language before, and that's a simpler, CC&R amendment than I was originally contemplating when you brought it up. But you're saying that even if you were to, it's not that type of language. Let's say every community out there, the membership was like, yeah, I'm raising my hand. Let's go. I'll fill out ballots. Let's release that. I will voluntarily assume the obligation in the event the board's not able to purchase it, or it's impractical, or whatever the reason is. But you're saying that even if they do that, that product might not be available to them based upon the nature of how their development's constructed. If it's
You
a stack,
have to fit into the underwriting guidelines of the personal lines insurance marketplace. So you have to be careful of that.
got it.
Yeah, but if it is doable, because it's going to be less expensive to the homeowner to
Way
get
less.
that HO6 or that HO3 policy than to pay the assessment increase for the master
100%.
policy, and it's cheaper for the association to go through a CC&R amendment ballot than it's going to be to pay for that insurance premium.
100%.
So if they qualify for it, it may make financial sense.
Absolutely. And so I'll tell you, if you have an HO6 policy, it's very conceivable that you might be spending $300 to $500 a year on it, right? That's your condominium unit owner's policy. If you get an HO3 policy, let's say it's $1,000, which is very real, right? That's not a crazy premium at all, high or low. So you're talking about a $600 difference per tenth, $400 to $1,000. Well, but you get full coverage, by the way. Well, first of all, you get to cancel your HO6 policy. You don't need it anymore. The HO3 policy, the homeowners, now makes the HO6 irrelevant.
Mm-hmm.
So your true cost is now $1,600 more. Well, compare that to the assessment that's going to be coming your way
Yeah.
for an association policy that doesn't even have 100% coverage for you. So it's way better financially for the unit owners if they can make it happen.
Makes sense.
Now, getting back to, because this is where people stumble on it, is like, I don't understand how personal lines is broader than commercial. So I just want to kind of dive into that a little bit more. The ones that I've seen, we've had a situation where the commercial premium, we beat that horse, we know, it went high. Then on the personal lines, it's not like every personal lines carrier is like, yes, we'll do that area, but we were able to find enough of them that they were able to get the whole communities covered. There's enough carriers out there to make it happen. Personal lines is just more friendly. Interestingly, we've had a situation where we've taken a commercial policy from a name brand company, I won't say who it is, and then on the commercial side, they're like, no way, this is extreme fire hazard. But then you go to the personal line side of it, and guess what? It qualifies.
The same company.
They use different fire maps between commercial and personal. Think of it as a different company, because it kind of is.
Huh.
So you have carrier X saying on the commercial side, no way will we ever give you insurance. But on the personal line side, they're saying, come on in the door. It happens.
That's crazy.
Yeah, I know it's crazy. But that is what's happening, and so you have to really be mindful of the fact that, as a general rule, personal lines is way more forgiving than commercial, and the HOA is in the commercial box. If you jump into the personal lines box, you might have a better opportunity. You just have to do some research. It takes a lot of coordinating. I mean, a lot of coordinating.
Just trying to think in the event of that loss, though. Let's say, okay, yeah, we've converted to HO3 policies, and we had a wildfire. I had a destruction event. I mean, typically the association would be the one getting those proceeds and directing the reconstruction and doing all of that. So how would the interplay be if now it's technically the owner's policy and the proceeds are being issued to them?
It's messy. And so basically, and again, this is not like, hey, I got a great idea. Yeah. This is, what do we do because of the absolute horrible situation we have? So I want to keep that under that.
Yeah, lesser of two evils.
Yes, exactly.
Got it.
But what you do is you make the association an additional interest on every single unit owner's policy.
Huh.
And then the association has more protection on that.
But now you're in an administrative nightmare because now you need to get copies of all those policies.
That is the manager in you speaking, and you were absolutely correct, Ramona. It is.
Yeah.
But again, we have an untenable situation.
Yes.
So it's.
So I guess coupled with that CC&R language saying we release the obligation, there would have to be something, in there saying, but the proceeds are essentially, under the control of the association, and the reconstruction is directed by the association.
Right. And then the other question I get all the time, and I think it's a great question, is, well, what happens if my neighbor doesn't buy insurance? Well, on one hand, it's the same problem today. If your neighbor doesn't have insurance, it's still a problem. But it's a bigger problem if you do this HO3 concept.
Mm-hmm.
So what happens? Well, I believe, and no attorney here, I'm not an attorney, I should say, you're here. The deal is this. If you have a situation, I believe, where the association policy, where the association has a fire and a unit owner doesn't have coverage, I believe that the association is going to have a responsibility to rebuild that unit because it's still their property. Mm-hmm. So what you do is you would have to pass a special assessment policy for the association, and all those, the HO3 policy, buy loss assessment coverage of $50,000, and then it adds up to the community, and everybody's going to have to go to their insurance policy and pick up loss assessment coverage to rebuild that unit.
Yeah, but that's what I'm saying.
That's a problem. But there's a solution.
It is, but I mean, if we're going to do a CC&R amendment, I mean, we could require in the amendment that the members get the insurance. It's not, they have to get the insurance. They have to provide evidence of the insurance, right? Because now we have disciplinary procedures that we can enforce to make sure that they get it and that we have copies of it and that it stays current. But again, that becomes the administrative nightmare.
Yeah. It's just one of those things where.
Yeah, my mind's racing right now.
Yeah, me too.
Structure the language, right?
This is my life right now.
Yeah,
so welcome to
special reimbursement assessment that you'd have to make specifically lienable. So yeah, we're rebuilding your condo because there wasn't, those types of things. But at the same time, we're throwing, a reimbursement assessment that we're actually going to lien on that condo as well in order to secure, reimbursement. I mean, there'd have to be all those protections in there. So it's the more I think about it, the more complicated it gets.
Well, and I'll tell you something. It's not universally accepted, I suppose, maybe. It just depends on CC&Rs. And so I just lay it out as an option and then say, talk to your legal counsel.
Yeah.
This is something you want to go through. I will help you do it. It's a lot of work, and I got to tell you, I've had friends of mine in my business, who have said, Patrick, I don't know, maybe it's just easier to tell them their premium went up and move on. It's just like, I just have kind of a moral problem with that. Mm-hmm. I just think, you know what, if there's a different way to skin the cat that works, and it saves this association from financial hardship, anyway, we're going to talk about it. Doesn't mean it's going to work for everybody.
Yeah, I mean, it
Doesn't mean
depends
it's gonna
on
work for
the
everybody.
locale and the type of development, type of owners that are in
Absolutely.
there. But yeah, I could see there's
Absolutely.
a situation, hey guys, we got to chop off each of your legs, but we can do a little bit of work and you only have to lose a foot. Which are you gonna go with,
Yeah.
right? Not to sound morbid, but yeah, that's crazy.
There aren't many options. I think we're in the position of we don't have a ton of options, and we're just going to have to start thinking outside the box and just realize that this is not 5 years ago,
Right.
right? And so we're going to have to start becoming creative with solutions, obviously within the parameters of our documents and with state statute, but we don't have any other option other than to get creative and figure out how to get insurance and how to pay for it.
Mm-hmm.
I know that you had mentioned that CLAC, the California Legislative Action Committee, has a call to action and that they've been talking to the insurance commissioner. Can you talk a little bit about that?
Yes, they've got something like 500 testimonies from managers and homeowners that have been affected by this, and they went to the Department of Insurance and they got a very, very welcome reception from them. And so now there's active conversation going back and forth on what can be done. Now, I don't know what the solutions are, meaning not only do I not have them, but I don't think the DOI, Department of Insurance, has them either. But I think having the conversation is certainly helpful, and it's gonna maybe it'll result in something good.
So it's good to know that conversations are being had with the Department of Insurance and that these letters are getting to the commissioner. Just off the top of your head, as crazy as it may seem and as unlikely as it may seem, what is a lever or a button that could be pushed by the commissioner? Could he say something to the effect of, hey, effective tomorrow, all preferred carriers have to price wildfire risk at X?
He could do that. However, I think the problem is very reminiscent of the Northridge earthquake, because what happened after that is the Department of Insurance had a deal where if you had a homeowners insurance client, you had to offer them, it was a mandatory offer of earthquake insurance. Well, the insurance companies just said, hey, Commissioner, we just really got blitzed by the Northridge quake. We can't keep exposing ourselves to these earthquakes. You have to let us get out of this mandatory offer. Department of Insurance said, no way, you can't do that. We're going to mandatorily make you still comply with this. So what the insurance companies did, they just sat on the sidelines. They stopped issuing new policies. So as it relates to this wildfire conundrum, I'm afraid that if the Department of Insurance comes in and says, hey, preferred carriers, you will do this at this rate, I'm afraid you'd have a complete vacancy in the market, and then we'd really be hurt. Because associations that are not in wildfire areas, they would be affected. They could potentially lose their coverage.
And the commissioner doesn't have anything with the excess and surplus market, right? So it would drive more people to that marketplace?
It would, but also Department of Insurance does have some authority over excess, just not the same as the preferred. So I don't want to be an absolute and say
Got it.
no, but not nearly as much. It's a much different world. And so they'd have to go excess surplus, and that's exactly what happened after Northridge. You had Farmers, State Farm, AAA, Allstate, all of them sat on the sidelines. So homeowners insurance moratorium.
Yeah, I remember when State Farm would not write a condominium policy. They were only single-family homes. You could not get a condo policy from them.
Yeah. So if the Department of Insurance comes in and forces the issue, I'm afraid that there'll be a boomerang effect. There has to be something where the insurance company is allowed to make some kind of money and profit on it. So maybe the Department of Insurance, and it's just me speculating, maybe they allow the preferred carriers to add wildfire deductibles, even $1 million. Look, I know a lot of associations that I've dealt with who, if I went to them and said, you can pay $500,000, and by the way, those come with high wildfire deductibles anyways, $100,000, or you can go pay $50,000 with XYZ preferred company, but your deductible is $1 million. At first sight, they'd go, oh my God, $1 million deductible? But when you get explained that all the HO6 policies that are in play could actually contribute towards that $1 million deductible, it's actually not so bad because it falls under loss assessment. So if the Department of Insurance allowed that, maybe that's an idea.
Is loss
Right?
assessment tied to every HO6 policy automatically? Or
Automatically, and then you can increase it from there.
Huh.
Right? Usually I think they start at $20,000 and you go up to $50,000. At least they start at $10,000, something like that. So it's very, very easy for consumers just to say, hey, I need more loss assessment coverage. The wildfire comes, you have $1 million claim, you file your assessment to your insurance company, and they reimburse you minus your own deductible. It's very, very simple. And so maybe that's an idea, but I don't know if that's being suggested, but that would be something. It's just like, hey, allow the standard markets to have large wildfire deductibles if that's the issue. then we keep the market more healthy. Maybe we allow the insurance companies, the preferring companies, to have a higher end charge. So it's like a lot of companies are like, look, we can't insure this risk for the most we can charge. What can we charge? It's what we're filed for. We're only filed to charge X amount of premium based on the metrics of this association. Maybe you could push that up to make it easier to get premium. Because as I said earlier, we have this big gap. We have a big gap between the preferred marketplace and then way off in the distance starts the excess and surplus lines carriers. And that's the problem.
Yeah, and I think that even though the conversation has started, I still believe that associations and managers need to continue reaching out to the Department of Insurance, because if we get quiet, it goes away.
That's right.
You know, we have to let them know that this is an ongoing issue and that it's just getting more and more expensive. So if you're being hit with these $300,000 premiums or higher, and you're in this predicament, CLAC has the call to action at caiclac.com, caiclac.com. There's a form that you can fill out that you can reach out to the insurance commissioner. But they need to know, right? There's 50,000 community associations in the state of California, I think, something like that. Yeah. And they've heard from 500. So you know, we need to get loud if we want to see some changes.
Yeah, we have to commend CLAC for doing a great job. They're really doing a great job, and also for associations, I would say consider joining CAI, because that's part of where your money goes, is for those lobbying efforts.
Well, great. I'm so glad that you came in today to give us this wonderful news.
Mr. Sunshine over here, huh?
Just, wow. You were on fire, though, Patrick. You were doing a great job. This was, this was sobering, but it's good information to know. I know that I learned a ton, as I always do when I sit down with you, so really appreciate you coming in.
Well, thank you for the opportunity. It's wonderful to see you.
Well, thank you so much. Make sure to visit our website at tinnellylaw.com if you haven't already, where we break down this episode. And stay tuned for our next one.
To share or subscribe to the Tinnelly Talks podcast, visit us at tinnellylaw.com. There you can find links to everything discussed in this episode, locate helpful resources, check out other episodes, and submit questions for future topics. And be sure to tune in next month for our next episode. As always, the views and opinions expressed by the podcast, its presenters and guests, do not constitute legal advice. For more information on the topics discussed in today's podcast, please consult with your association's legal counsel. This is Tinnelly Talks, presented by Tinnelly Law Group, your community, your counsel.